According to Experian's State of the Automotive Finance Market Report, in the second quarter of 2023, consumers continued to opt for shorter-term loans. On today's show, we're joined by Melinda Zabritski, who is the Senior Director of Automotive Financial Solutions for Experian, to go further in depth on the report's findings. Melinda, thank you so much for joining us once again here at CBT News.
Thank you. It's always a pleasure to be here.
Great. So tell us about the State of the Automotive Finance Market Report. What were some of the key findings in the Q2 report?
Well, the State of the Auto Finance Market Report is a quarterly publication that we put out that talks about what's happening in the auto finance market, really derived from just what are consumers purchasing, what's happening with loan payments, rates, terms, et cetera. And throughout Q2, as well as in the most recent months, we're finding that the auto industry is very strong. Consumers are certainly out there shopping and buying. But what's been interesting is, especially in this raising rate environment, we're finding more cash in the marketplace. And what you don't expect is, you would think as cars become more expensive and loans are more, you would think consumers would have longer terms. But we're actually finding that terms came down. And a lot of that was driven by the incentives that we saw in the marketplace in the most recent months. Is most of the incentives that were out there, especially for new vehicles, were 48 months. And that had the impact of just driving the average term down a little bit.
Yeah, wow. What was the reasoning for captives regaining market share in that quarter?
Well, definitely we saw numerous captives, numerous manufacturers have incentives out. Days supply has improved. More cars on the dealers' lots, and those that had strong inventory, we certainly saw more incentives in the marketplace. And so if the captive was running incentives or the manufacturer had incentives out there, that share definitely went to the captives. Credit unions, however, still had very strong share. They're the number one lender in the used vehicle space right now. Bank share has been declining. But especially for new cars, that's really dominated by the captives, who do over half of all the lending for new vehicles.
That's interesting. You would think that the captives would still want that used car paper as well and be aggressive on that.
They do financing in the used vehicle space, but usually the captive share is pretty low for used. Most of the financing the captives are going to do is definitely new and very late model used. So some of that certified pre-owned financing.
Sure.
But captives only have about less than 10% share for used.
Interesting. And it's interesting that credit unions are that strong. So despite the average vehicle loan amounts leveling out, average monthly payments are still increasing. Why is that?
Well, the payments are certainly increasing, mostly because of the higher interest rates. If it's not incented, your average rates that you're going to find out in the marketplace right now are honestly in the 7 and 8% range, even in very strong credit categories. Average rates just continue to climb. And with that very slight drop in term, it did have the impact of still increasing the monthly payment. For new vehicles, we are in the $700 range, around $730. For used, we are well over $500.
Wow. So how has the rise in interest rates affected loan terms in Q2?
Well, some of the things that we have found, especially for very prime consumers, is, first of all, more cash in the marketplace.
Really?
And then secondly, for those consumers who can afford it, taking the shorter terms possible. Like I said, we've seen a growth in 48-month terms. We've seen a growth in 60. 72 is still the most common, but more consumers are opting for shorter terms, and very likely as an effort to just reduce the overall interest payments.
Yeah, that's very interesting because with the average price of a new car being just under $50,000, you would think just the opposite. You would think that 84 months is now the norm just to afford these vehicles, right? And especially as we see more EVs coming into the marketplace.
Yes, certainly. That's what people expect to see. As things become more expensive, one of the ways to keep the payments down is to push out the term. And while certainly there are numerous 72-month loans out there, and 84 does continue to grow, we even see a growth in 96 plus from a term standpoint. But lately, the growth has really been in the shorter terms.
Do you see any decrease in the average credit score out there among auto consumers?
Actually,
Increase?
no.
No?
No, so yeah, credit scores do continue to climb.
Mm-hmm.
We find that the average consumer credit score has been increasing. On new vehicles, it's in the mid 700 point range.
Okay.
For used, it's actually, I think, around 680 or so.
Mm-hmm.
But overall, we're finding that more consumers are prime. There's been just an increase in overall credit scores as fewer consumers are falling into the subprime category.
Mm-hmm.
And we're also just seeing fewer originations in subprime.
Interesting. Very interesting. So if you were to hear that, you'd think, well, the economy's doing pretty good then, right? I mean, contrary to what you hear out there in the marketplace about the economy, that you'll hear from some people that, oh, delinquencies are up and this and that. But if you hear those stats right there that you've just shared, things look pretty good.
Well, scores are increasing, but yes, delinquency is also increasing. And especially as we have, monthly payments climbing higher and higher, you are going to be more likely to run into delinquency as payments continue to climb, especially in the subprime space. Subprime is where most of the delinquencies originate.
Right.
And those payments are continuing to increase. So yes, we do have delinquency climbing. The positive, not necessarily from the consumer standpoint, the positive from more of a financing standpoint is while the values are still high, the charge-off rates are actually decreasing. So repossessions are up some. Yes, delinquencies are up.
Mm-hmm.
But with values being high, as if a lender has to repo a vehicle,
right,
it's garnering more on the auctions than what we would see historically. So the charge-offs are low, which does bring down that consumer deficiency balance.
In fact, that consumer that lost their car might end up getting a check back for after all is said and done on the repo. What's this check for? Well, he's actually sold it for more than what the loan amount was.
It's possible. Values still are high. So anything is possible right now.
That's crazy. That's crazy. Was there anything else that surprised you about the findings?
It's the auto industry has been very consistent.
Mm-hmm.
Luckily, there's nothing that's overly surprising. The one thing that does catch your attention, of course, is certainly more cash in the marketplace.
Mm-hmm.
And you mentioned EVs earlier, and this was the first time we actually had an electric vehicle in the top 10 leased models.
Mm-hmm.
So that was definitely attention getting as EVs become so much more prevalent and pick up increasing market share. We had it in the top 10.
Yeah. Wow. We're making some progress in the EV market. That's pretty cool. That's good to hear. So Melinda Zabritski, who is the Senior Director of Automotive Financial Solutions for Experian, thank you so much for joining us today. Very much appreciate it. I know that our viewers will get a lot out of your visit. Thanks.
Thank you.